Hello and good morning friends, welcome to the CEC-UGC live lecture. Dear friends, in our previous session we had a vivacious lecture on capital working, and we discussed a lot under the series financial management. And dear friends, we would like to tell you all that taking the lecture forward on capital management today, working capital, today we would be talking on one of the most important aspect of working capital, that is cash management. And for this discussion we have once again with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting and she is teaching in one of the leading institutions in the country. She has authored number of books, number of the articles are to her credit. She has written articles both in national and international journals, and she is a certified management accountant. So let's welcome our guest Dr. Amarjeet Kaur, and let's try to grab maximum knowledge through her experience on cash management. Hello ma'am, welcome to the lecture.
Hello Gitika. A very good morning to viewers. As Gitika introduced, this lecture is extension of working capital management, which we covered in the previous lecture. So today we will be talking about cash management, which is a very important part of any business. So before we talk about cash management, let's talk about what is cash, what does it comprise of, and then the tools and techniques for cash management. So let's understand first that for the purpose of financial management or for the purpose of working capital management, what does cash constitute? So cash does not mean only the hardcore currency. Cash means the cash, hardcore currency of course, your bank balance and all marketable securities which are equivalent to cash. So cash and cash equivalents are part of cash. So this is first thing very important, that we should understand what is cash. So when we understood that cash does not constitute only the cash, the hardcore cash, but also constitute the bank balance and other marketable securities which can be converted into cash very easily without much loss. So that's what the cash stands for, right? So before talking about cash management, let's talk about why do we hold cash and why it is so important to talk about cash in financial management. We do hold cash for a couple of purposes, motives. The first important motive of holding cash, which is cash and cash equivalents, is transaction motive. We want to deal with everyday's operations. We want to pay for wages, we want to pay for supplies, we want to pay for salaries, we want to pay for small stationery, small items which we use in the business on day-to-day operations. So it may go to anything, either hosting a lunch for a client or paying for tea or paying for stationery or paying for transportation. Your employees are going using auto rickshaw or cab or anything such, so we need cash for all such purposes. They all are part of transactions of business. To carry business transaction, why my employees is traveling? Because he may be either going to deliver the product or to receive the order or to any other business part of any business operation. So we need cash for all these business transactions. So when we hold cash for carrying business transactions, which we just mentioned, and this is not the complete list, it's not an exhaustive list, there could be 100 more examples, but I hope you are able to understand. So they were just indicative. So cash is held for such transactions and for such purpose, and that is known as holding cash for transaction purpose. So motive of holding cash is transaction. Other than that, we may hold cash as precautionary purpose, precautionary motive. So what is precautionary motive? Precautionary motive means we are holding cash so that we could take the benefit or we could meet up any such emergency which just emerges during the course of operation of business. It could be you may have to you may suddenly lose some case. and have to pay some penalty. There could be certain demand from tax officers. There could be certain certain loss in terms of foreign exchange currency if you are dealing in you are working in the international market. So any such kind of situation may demand that you have enough or plenty of cash to pay for it. So either it's a taxation demand, or it's some client demand, or losing some case. So such holding or such purpose of holding cash is precautionary purpose. We may hold it so that we could in case there's some medical emergency, if I'm a manufacturing unit and the business could be hazards. So business hazards, the production hazards may cause some kind of health challenge, some kind of accident to the employees, to the laborers. So we may have to spend on medical immediately. We cannot wait for checks. We cannot wait for marketable securities. Then in that case we need cash in the most liquid form, that is in the currency form. So all these purposes for if we hold some cash is known as precautionary purpose. So business need, number one, transaction cash for transaction motives. Second, business need cash to meet up the sudden or emergency situations, which we call it as precautionary measures or motives. The third is that we may hold cash for speculative purpose. Now, what is speculative purpose? Speculative purpose means we want to take advantage of certain situations which are not there on day-to-day basis otherwise. For example, we may end up buying some inventory at a very minimal rate or at a very discounted rate if we have cash, and that situation is not always known to us when that can happen. We know it happens for times but not known exactly. So we may hold cash to take advantage of such discounts. Some business policy has changed, some other business is winding up, and we may like to take the advantage of acquiring that business. So we may need bank balance, that is cash only, right? So some speculative purpose, you may like to bargain with some tax authorities, you may like to bargain with you may like to bargain with, for example, some case is going on for some tax demand is there, either for service tax or sales tax from some tax department against you, right? And you are not sure how it would go, because you have your own points and tax authorities who are demanding have their own reasons to demand for. So what happens, you would like to hold some cash so cash doesn't mean, as I said, hardcore cash in your bank or so that you are able to bargain with the authorities and tell them, okay, I have just X amount with me and I am ready to pay for this if we can settle at this. Because tax authorities are not very sure, or even their logic is not very valid, and you are kind of struggling to make them or convince them about your logic which you are presenting on behalf of business. So you may like to hold cash. So this is a kind of precautionary measure, and it could be speculative. This example could fall under both. You may hold it as a precaution because some legal suit is going against you, but speculative because you want to take advantage of the bargain power you may have at the point of time when the situation occurs, when you lead to that situation, right? So other than that, the best example to understand speculative is when we want to take advantage of discounts. Especially the people who deal in food market, who deal with seasonal products and the agriculture products, they know how much important is to understand the speculation which goes in mandis. We have anaj mandis across the country. I hope you all understand. And there are artiyas and all, which we call them as artiyas, the people who deal with the produce, who buy on wholesale. So they may like to take advantage if some farmer has some marriage in the family, or some other requirement, and they want to sell their produce. So you should have enough bank balance or cash with you to take advantage of that situation. So holding cash for that purpose is an example of speculative motive, right? The last purpose, last category for which we do hold cash is compensative motive. So what is compensative motive? Compensative motive means we are holding cash because we have to comply with certain guidelines, either laid down under some loan you have taken, or guidelines laid down by the accounts you hold, bank accounts you hold. For example, you all know that even if you have a saving account, for a business of course you don't deal in saving account, you need to have a current account. But just to take an example, as a student, if you hold a saving account of a bank, for most of the banks there is a condition to have X amount as a minimum balance in your account on all days. Generally, most of the times it is an average balance, it is not an absolute value, but for terms loan it could be an absolute value as well, right? So that particular cash is kind of compensating cash so that you could have an account. So this particular amount of cash which is there in your account all the time, you are supposed to. For example, I know I have my bank account and my cash cannot go down below 10,000. It's a saving account even. So that is a compensating amount which I am holding all the time on an average basis with my bank, so that I could enjoy the benefit of having my bank account with the bank, right? So in the current account, this amount could be little higher. If you have a term loan, so if you have taken a loan of working capital from a bank, then there could be a need for a higher amount. If you have, it's not only for term loans. If there could be a covenant as a part of the loan you have taken from a financing institution, may not be a bank only, right? So of course they all are financing institution, but other than commercial bank, if we go for term loan or some project loan from a financing institution like NABARD is there, SIDBI is there are many of them in India and across. So if we are using some term loan or project loan from any of them, so there could be a covenant saying that you must keep X amount always. So this could be an absolute amount or this could be an average. So it all depends. Certain businesses, certain institutions lays down absolute value as a minimum requirement to have all through the time, and other may have it as an average. So keeping absolute is rather a difficult one than an average. You may maintain average, just because then you are little flexible to keep or get the balance go down than the average one. For times you may have a higher amount available, for times you may have lower. So at the end of the period you are able to keep up to the average amount. So such covenants which lays down that you must have this much balance, and for that purpose whatever we hold in our account is known as compensating motive of holding cash. So in all there are 4 motives of holding cash. I hope you could understand that why do we need cash. So all these so this discussion leads to one important point, that cash is the most important factor in any business. That's why if you go through the books, you will find many books, many authors saying it as or taking it as a oil for the business, lubricant for the business, without which the wheel of business cannot run, which is true. All the 4 motives are very important. The first one, as I said, transaction. So you are carrying business transactions and you are holding cash for that purpose, either to pay to the wages or just to pay for the samosas or the lunch your client had. tea your client had with you, right? You are supposed to pay for all of them. So we need to hold cash for all such purposes. Bank balance, it varies from day to day, it varies from business to business, it varies from country to country, depending upon your credit worthiness, how do you operate. But nevertheless, we all need to hold cash for all the purposes we just mentioned and discussed. Now let's move forward and discuss what is cash management. So when I said we should be holding cash for this purpose, I do not mean that we should have excess cash all the time and we should be able to cope up with all the demands without any problem. That doesn't mean. Why? Because cash is an important element of working capital and the most important factor for business to run. But cash in itself, cash per se, is not a productive asset, right? Cash is a current asset, we all know, but cash is not a productive asset. What does it mean? Cash in itself does not generate any revenue. If we have plenty of cash lying with us, basically the cash is lying idle if we do not need that much cash to meet up all the 4 motives or reasons I just mentioned. So if we are holding more than what we need to cope up with the demand for under these 4 categories which we just discussed, it means we are wasting our resource. We are not earning anything and we are holding cash, because the most important aspect in cash management is this, that cash is a non-productive asset. So which means we should never be holding more than a desired level of cash. This is one aspect of cash management. But after saying so, having said so, I would further go and say that it doesn't mean that you are not able to meet up to your payment schedule, right? So there are 2 things in cash management. One is managing the payment schedule, right? And second is deciding the minimum balance of cash. So cash management deals with these 2 important aspects. Interestingly, these 2 important aspects are in conflict with each other. They don't go hand in hand. If you are able to meet up the schedule or payment schedule, means you are keeping a lot of cash with you. Cash doesn't mean the cash in currency only, as I said 5 times now. But if you are not keeping enough cash to meet up the schedule, means you are not able to meet up to the payment schedule, and you are going to be taken as technically insolvent in the market. So technical insolvent means you are not having enough cash to meet up to the immediate demand, short-term liabilities. So these 2 aspects, that maintaining the minimum balance of cash and being able to pay or make payments as per the payment schedule, are conflicting but yet important aspects, and we have to trade off somewhere and have to reach an amount which is the most desirable balance, and that is the purpose of having cash management system in the business, right? Now let's move forward and discuss about so it means the objective of cash management are 2. So 2 objectives: meeting payment schedule and minimizing funds committed in the cash balance. There are the 2 objectives, and the final is that we have to make a optimum cash balance. So we have to reach to a point where we are able to make a trade-off between the 2. Moving forward, let's talk about factors which determine cash needs. So there are a couple of points which decide what should be the amount of cash, and should we be keeping a low balance or should we be keeping a high balance. So the first important point is synchronization of cash flows. Synchronization of cash flows means, let's understand two things. In cash flows, there are two aspects. One is cash inflow and another is cash outflow. So, in cash management, we are dealing both of them. We are dealing with inflows as well as outflows, right? So, there should be a fine synchronization between inflow and outflow. If there is a very fine tuned synchronization between the two, means a business would need minimum cash balance to hold any time. So the amount of cash to be held by a business at any point of time would be basically dependent upon that how well our efforts are to manage our inflow as well as outflow. So let's take it further. Our inflow is an outcome of, cash inflow is coming up. Why? Because we are selling cash, we are collecting from credit sales, we are receiving interest on time if we have invested somewhere, we are receiving dividend from our investment, we are receiving rent from our investment in building, etc. We are able to claim our tax refunds on time. So these are the inflows. And outflows are that we are paying for supplies, we are paying for wages, salaries and other overhead expenses, right? So if we are able to manage the time lag between payments, how much is the time lag between the payments and the time lag between the collection. I sold today, how many days I do take to collect, and I purchased today and how many days I do take to pay for it, to pay for supplies. So this is known as time lag. So time lag between the two for payments and for receipts is basically something very, very important. If we are able to keep the time lag almost at the same pace, and rather the best would be our time lag for receipts should be shorter than the time lag for payments, then we would never need to hold cash. Yeah, interesting, right? Our cash balance to be kept at any point of time would be very minimal. But if we are not able, or if it is other way around, we are paying after every 30 days and we are receiving after every 60 days, then there's a problem. You are paying in 30 days after you purchased and you are receiving after 60 days once you sold on credit, right? So and the difference of 30 days in total process, one is 30 days, another is 60 days, right? And that would need that would really demand on your end to keep a good balance of or high balance of cash to meet up for all demands. This is one determinant which decides the cash need. So this how much cash a business would need will depend upon how good the synchronization is between the two. The best synchronization or best situation could be when our receipts are collected earlier and our payments are delayed. Okay. The second is short cost. Short means the shortfall of cash and how much does it cost. So if I decide to keep a minimum balance and if there are emergencies and I have to pay, so I am falling short of cash balance, then because of the average balance which I am keeping is low, so what happens is this, that I may have to procure cash on certain basis from the open market, from my friends, from the money lenders, right? We do have a good good network of money lenders across the country. That's what we understand. So we would have to procure money from the money lenders or from any such source, and how good we are. If we fall short of funds, how good we are to procure money. So this is not, and how much we would have to pay for it would decide the need for cash. If I am a business and as a business I am able to procure my shortfall easily without paying or incurring much cost on it as an interest, then I may not like to keep a high balance of cash all the time, because cash is a revenue generating asset as we know. So in that case I need not to. But take an example which is just reverse to the situation we assumed. We are a business, and we are a new business, and we are established in a new city which is not our native place, and nobody knows me much. So what happens then? Of course I will have to go and procure loan on short term basis to meet up my shortfall of cash at a high cost. So that would decide my shortfall, my short cost would decide how much cash I would like to keep at any point of time. So my need is decided this way. The another is excess cash balance. So what is the cost of excess cash balance for me? So if my saving account is able to give me 6%, and I'm not keeping in my saving account, rather I'm keeping as a hardcore currency with me, I'm losing 6%, right? So how much cash of excess I do keep, and how much revenue do I lose by keeping that much cash with me would decide the need for cash, how much cash you or balance for cash, right? So there are countries where there is no return in saving accounts, rather you have to spend in from your pocket to keep up your saving account. There are few countries, but we in India, we are fortunate, our economy is doing well, and even our saving account fetches somewhere about 5% on an average. So in that case 4 to 5%. So in that case business would like to keep in the banks instead of a hardcore cash, but cash and bank are almost same, so we are lucky. But the countries assume a situation where you do not have much banking system, you are operating in a small city, there is no bank around, or a very small faraway village where there is no commercial bank, you are keeping cash and you are losing revenue on it, right? So how much revenue do you lose would decide the need for cash, the amount of the cash you keep. The another is procurement and management cost. Is not the cost of cash itself, the interest cost. It's also the procurement cost, the processing cost of cash, the management of it. So if you have to keep a locker, if you have to keep a security guard, it all depends how much cash you need to keep. So and which business you are in. So if it is the case, then it will it would be one of the factors which will help you decide that how much cash you should be keeping at any given point of time, because the cost for managing cash is different than the cost of procuring or the cash itself. The cost of cash itself is the interest you pay, right? And the procurement cost is the processing cost. If you put up a request for a short-term loan, then there is a processing cost, right? So this is different. The last thing here is uncertainty and the cash management. How uncertain your business is, or your business situation is, or the economic situation is, or the industry situation is, would decide your need for cash. If you are operating in a very certain situation, the economic situation is quite reliable, we know our banking system is quite strong, is reliable, or we have a strong network which can give you cash at the time in case it is required on an urgent basis, then you need not to keep a high balance. But if situation is contrary, then certainly you need to keep a high balance of cash. So these are the factors which decide how much cash should be kept in any business at a given point of time. I hope you could understand the cash management and the determinants to decide need for cash management. Thank you for watching. Thank you. A very good afternoon to you all and welcome back. This is the second module in cash management. In this module, we are going to talk about that what are the techniques available to manage cash, or to carry cash management. So there are a couple of techniques, we will talk about them, but let's understand the two important aspects which are kind of primary for the discussion. First thing is that we can manage cash management. We can manage cash management by taking care of our payments and by taking care of our receipts, which means to have a better cash balance, we need to delay payments and we need to make early receipts. So there are two different aspects. One, that we are trying to delay payments, and another is that we are trying to make early receipts. Alright, so delaying payments, there are a couple of techniques. We will refer to the slide later. Delaying payments means that you are trying your level best so that you are keeping your credit worthiness in the market on one hand, and on the other hand you are able to take advantage of credit schemes offered by your suppliers or other parties to whom you have to pay, right? So it means using certain good techniques to delay payments, and another is that you are trying and using certain techniques including the technology to make early recovery from the people you have to receive, right? So two different things, but both of them are important. Other than that, the third thing is making advanced planning of cash, which is generally through cash budgets. So three important things: cash budget as an important technique or tool for cash management, second is delaying payment, and third is early recovery. So now we will discuss in detail what all do we use as tool under these heads. I would be holding cash budget to be discussed later in the last half of this particular module. And in the beginning we will be talking about that how can we delay payments, what all practices a business can make. You may choose any of the important practice which you feel is good for your business, but I am discussing the available choices, right? So let's discuss about that how can we stretch accounts payable. So have a look at the slide now. So stretching accounts payable without affecting the credit of the firm is the agenda, is the one important aspect. Here we use a technique like float. Kindly follow my cursor. We follow paying from distant bank. We follow this technique by using centralized disbursement, and we follow this technique by causing accruals, right? So first thing is float. So what is float? So float is basically that you have paid, but from your side you have issued check, right? But the recipient is not able to encash it because the check is on its way. Either it is in the process, through courier. If you are sending it a postal agency, then it is with the post office in transit. If you are sending it a courier guy, it is with the courier company in transit. So one is that your check is in post. So we call it as postal float. So check is floating in the transit. So you would say that I have paid today on 18th, but the check is going to go to the south of India. You are in North India, so it may take 4-5 days. So these 4-5 days which you saved because you issued a check from your head office which is in North India. So this is known as float, and especially the postal float. So this is one. The other thing could be you paid today by writing a check for a date for after a week from now. So the time for transit is 5 days. It reached after 5 days to the client, but client cannot put up in the bank because it is post dated, it has another 2 days yet to claim, right? So this is another float, this is the bank float you are using, and then your bank may take a day or two to pay it, right? So total float would be say 8 or 9 days. So basically you technically has made payment, you have made payment to the client, you issued a check, you posted it even or couriered it even, but the actual payment has not been received by the client. So these all are either the postal float or bank float. So the check is floating in the air, in the system, right? So hope you understand. So this is one way, one technique or tact, I may say so, used by companies to delay the payments, and side by side we are keeping our credit worthiness because we kept the payment schedule, we kept the deadline for the payment, right? Another is you may like to pay from a distant bank. For example, if you are a business and you have branches all across the country, right? So you have to pay to someone who is in south. You can, the choice is that you can pay from a office or a bank branch which is in south. This is more true, this may not hold true after there's a revolution in banking system, but it used to be very, very strongly true earlier in the past, but even then it can be exercised to some extent. So example is that you are a business and having branches all across the country, and you have to pay to a client in south. You may like to issue a check either from a branch which is in North India or in East India or West India, not from South India. Why? Because you would like to enjoy that you could take the advantage of postal float, if not the banking float, because nowadays banking float is no more effective. It's not very, very effective. You can take advantage of issuing a post-dated check, but bank float, because now our checks are having that feature, irrespective where do we issue them from, they can be paid without delay, right? So this is one important aspect of delaying a payment, that you take care of that from which branch you are going to issue the check from. Okay, so this is the paying from a distance bank. The third point is centralized disbursement. This may not be very, very effective, but this can also be exercised, one of the tool nevertheless. That when we pay from one location only. So that could be from head office. Generally we see this is from head office. So you are paying in different parts of the country and you are paying from one particular office. So if your head office is north, it means for the remaining 3 zones, east, west and south, you are delaying the payment. If your head office is in west, and for remaining 3 zones, east, north and south, you are delaying payment. So you can use the practice of having centralized payment, because the option is there that if your operations are all across the country, you can pay from the branch which is near to the client. That would not give you advantage of postal float. Okay, so this is another way of delaying payments. So the tool is delay payment, and under that tool we are talking about the options available, the practices we can have. Another is that we can use accruals. We actually may delay the payment even beyond the deadline. So which is not a very good option, but if you enjoy a good reputation, if you are sure your business is not going to be affected adversely, you may exercise this thing for times, for in case of emergency, in case you shortfall, you are falling short of cash in a particular time period, in a particular week or so, then you may like to exercise this, but not as a regular practice. So one important technique of managing cash is that we delay our payments. Okay. So another important thing is that inventory also has effect on our cash management. How come? Inventory management means how easily what is the rate of inventory turnover, how easily your inventory is being sold, or if you are a manufacturing company, how easily do you convert your raw material into finished product, right? So that is the days in inventory. So inventory management is important aspect, because if you are able to sell inventory easily earlier, you are not holding inventory for many days in your stores, in your warehouse, so it means you are converting inventory into cash. If not 100%, to some percentage. You may be selling on credit, I don't deny, but you are going to certainly sell certain amount on cash for most of the businesses, that they have practiced to sell certain part on cash, certain on credit. I won't deny the fact there are businesses who sell absolutely purely on cash, and there are businesses who sell purely on credit. You just take an example of buying from Amazon, so I should not be naming any such e-commerce company. So if you are buying online, then of course you are paying on cash. So such companies are selling 100% on cash. Either you are selling if you are paying online immediately, but if company has COD option, cash on delivery, then there's a delay in the cash recovery. So it makes a difference that you pay immediately and you order, or you opt to pay on delivery. So it makes a difference for a company, right? Because if company is buying inventory and then selling to you, you place an order, they need to buy later after you place an order, right? So if you are following just in time inventory technique, so we are buying inventory once we get order, and this could be true for certain products, if not for all products. Then what happens? You are basically if you are receiving cash before delivery, basically you are enjoying as a company. So, but from company's perspective, this is different. From customer's perspective, it's a different viewpoint. It will always be inverse. So we are as of time, we are talking about delaying payment. So we would discuss the other aspect of receiving payment early, just after a few minutes from now. So under inventory management, what happens? That if we are very well in managing our inventory, it does not stay much long in our warehouse. So we are able to convert our inventory into cash. So I hope you understand, I am referring to cash cycle. So in the cash cycle, what happens? First we buy inventory, raw material or inventory, depending upon what kind of our business is, if it is a trading business or a manufacturing business, right? So the point is we are buying inventory, we are then selling the inventory, then we are receiving checks, depending upon the credit sales and all, then we are collecting from the customers, and then we receive cash. So cash to raw material to sales to wapis cash, right? So this is how it is. So this is known as cash cycle. So cash cycle is important for any business, and it varies from business to business. There are businesses for whom the cash cycle would be just a day only. There are businesses for whom the cash cycle would be very, very long, right? So the point I am trying to make is that the cash cycle would decide how the inventory moves. But nevertheless, for cash management, inventory management is important. Inventory management affects our cash cycle and cash management. Okay, so let's move forward and now talk about the other aspect of cash management, which is in a speedy collection of accounts receivable. Once we discussed about cash payments, delaying the payments, now I am talking about how to collect early from our receipts or our receivables. So under that we should be, first of all, we should be encouraging prompt payment from our customers. So it means we should have a system where we keep follow up with our customers and encourage them to pay timely. Just to quote an example, if your parents, your friends, or if you have a life insurance policy or any other insurance policy, you would see, you will get a reminder call almost a month before the due date. And as a student of finance and accounting, and otherwise as a general, we understand we do have 1 month even beyond the due date. So if my policy insurance is due on 2nd of June as per my policy, I as a customer has a right to pay it by 2nd of July instead of 2nd of June. So this is what is known as so what happens? So the point I am making is this: as a company which is into insurance business, they start calling or reminding you a month before the due date, which means you may start getting calls beginning from 2nd of May. So what is the date of your premium due? Premium is due on 2nd of June, right? You have the right to pay it by 2nd July, because this is under regulatory guidelines, insurance regulatory guidelines, that a customer can pay, a client can pay after 1 month of the due date. So it means the actual due, technically you have the period to pay by up to or by 2nd of July. But when are you getting a call or a mail or reminder text from the company? 2nd May, 2 months of advance. So this is what I am saying. As a business, if I am talking from the company's perspective, not from your perspective. If we look at from company's perspective, from their business perspective, this is what they are doing. This is what I am saying. As a technique of timely collection, we should start sending reminder. We should encourage prompt payments, right? If you are a student, if you look at your college, you would be getting the demand for the fees maybe a 2 months in advance. Few of the parents may pay, right? And this is what the college management is basically managing cash. If they are able to collect from even 10% of the student in the first week of issue of notice, so they may be able to use that cash to pay salaries for their employees, right? They may use that cash to meet up any such obligation they have to pay for their interest, their installment for the loan. So if they are able to get another 20% in the next week, so that 20% is on their disposal. So reminding, so prompt follow-up, follow-up for the prompt payment is an important aspect and technique which is used to make early recovery of cash, right? The second is that early conversion of payment into cash. So now I am talking about if you are receiving payment through checks, so you should be avoiding minimum floating of the check in the system, either in the post or in your system itself, in a company itself, or with the bank. So there are 3 kind of floats. So one is, in the second kind we call that a lethargy, when your employees, so one is you encourage your customers to send it through speed post, so that the float in transit is minimum. Now you are recovering. So when you were paying, you were exercising the opposite. Okay, now we are talking about recovering timely. So now in this case, you should be trying to encourage your clients to pay you by means which takes minimum time to reach check to you, right? So, or draft to you. So this is kind of reducing time lag between the check issued by the client and received by you. Second is, check the lethargy of your employees. Your accounts department receives check on 6th, and 6th is Friday afternoon. So Saturday if it is working, but for half day, now we have a different system in the country. So or the next Saturday is working, so bank should be, your employee should be active to go and deposit the check by Saturday itself. Otherwise they will lose Saturday as well as Sunday and would be depositing on Monday, right? If they received on Friday afternoon, they should try to go and deposit it, so that it goes into clearing on Saturday itself, Saturday being working. So this is the lethargy. So you need to check as a business, as a management, you need to check on the lethargy of your employees, so that our check is not in floating within the company itself after being received. Third is we should have good terms. We should be banking with a bank which has a good system, and they make early recovery or early collection of the cash, checks. Though there are guidelines by the RBI, there are guidelines which says that bank should not delay, but even I have practiced, I have experienced bad here. I have deposited my check and it was just lying in the drop box. So you can encourage your employee who deals with bank not to drop in the drop box of an ATM, rather to drop in the drop box of the branch itself, or to hand over. In our country, people who are having current accounts and having good business with the bank, they enjoy certain privileges. So they can hand over the checks to the executive sitting in the bank itself. This will save floating with the bank. If bank is able to send the check on the very same day for collection, you are saving time. It means saving time means the early recovery of recovery of cash or conversion of check into cash. So your bank balance goes up. You are able to use that funds for any purpose you want to, for any of the four purpose we just discussed in the beginning of this session today, right? So moving forward, the next is concentration banking. So now you can enjoy concentration banking to delay, to receive early from or collect early. So you can encourage your clients who have to pay you, to send the check to a branch which is near to them. So concentration banking can be used both ways. So one is you are using concentration banking by delaying for purpose of delaying the payment, and now we are talking about concentration banking for the purpose of receiving early payments, right? So in this case, what will you do? You will encourage your clients to pay you or send the check to a branch to a office of yours which is near or very close to their office, so that the postal float is minimum, and you receive the check at the earliest, and then you can cash it at the earliest possible, right? The another option is lock box system. Lock box system, and this word may sound something new to you, to few of you, but in actual we all have seen it happening. The moment I am going to give you an example, I hope you are going to correlate. Lock box system is a system where companies may install a drop box at different convenient places. Or for example, I have to pay my insurance, and insurance company may install a drop box in a post office, in a fuel station, that gas station, you may call it as petrol station, fuel station, right? In US we call it as gas station. So the drop box are there, and banks of that particular, so they are across the city. For example, for a very leading brand of mobile phone in our country, I would not like to name it, they have drop boxes. In the beginning, I remember dropping my check for the bill, a monthly payment for a postpaid bill, in that box. So that is known as lock box system, where the company may have given the right to a bank of near branch, go and collect the check on daily basis. And there are companies who have a tie-up with banks to collect not on daily basis, but for more than once in a day. It's interesting. I hope you all have seen it happening. You may not know this word. So lock box is basically what is happening here is this: you are using it as a tool to recover early. So you are managing your cash. You are actually trying to receive as early as possible from your client, right? So these are the tools. The last thing is I would like to talk about is that cash budget. Cash budget is the best tool for managing cash. In the cash budget, there are three aspects. One is that we should be forecasting our receipts, cash receipts. Another is that we should be forecasting our cash payments and then our cash balance. So cash budget has three segments, three parts in it. One is that we are forecasting our cash receipts. Those receipts could be either from operations or from other non-operating items like financial items. Then another is that we are making our payments. These payments could be for operating items or for non-operating items, like you are paying installment for your machinery, you are paying installment for your any other asset you procure. So we manage our cash receipts, cash payments, but by planning it in advance. We are writing a document. I hope you remember, in our in the past we have discussed about how to prepare a cash budget. That is out of scope for today's lecture, but otherwise, just to refer, cash budget means making a document in advance, which has three segments, where we are writing that where are we going to receive in cash, where are we going to pay for, and then what would be the balance for each of the cash period. So this cash period could be every month for a business, it could be a daily basis for a business, for another business it could be a quarter. So we have a projection that in which month we would have surplus of cash, or which day we would have a surplus of cash, and which day or which month we would have shortfall, right? So this is what we understand. So this is another important tool, and almost every business across actually exercise this cash budget as a tool for managing cash. So this is all about the cash management. I hope you could understand the discussion we had today. Thank you very much.
Thank you, ma'am. Thank you so very much. And dear friends, do write to us at info.cec@nic.in if you have any questions, or if you want to give your feedback for this particular lecture. We would be meeting again soon. Till then, take care. Goodbye. Thank you, ma'am. Thank you once again.
Thank you.